Welcome to our video on the key terms you need to know to navigate the derivatives market like a professional. Today, we are breaking down the mechanics of futures contracts using clear examples from indices like Nifty and Sensex to help you understand how these trades actually work. Let us start with a simple idea, which is the price difference between what something costs right now and what it is expected to cost in the future. In the world of finance, we call this the basis. You find it by taking the current cash price, also known as the spot price, and subtracting the futures price. For example, on October 03, 2025, the spot price was 24,894.25, while the futures price was 25,006.60. This resulted in a negative basis of minus 112.35. It is important to remember that the basis is only a complete picture when you specify which contract month you are talking about. You can think of the basis like a rubber band that stretches and shrinks as time goes on. Throughout the life of a contract, this gap between the spot and futures price will fluctuate, sometimes being positive and sometimes negative. However, as we reach the final day of the contract, something interesting happens. The basis becomes zero. This is because on the day of expiry, the final settlement takes place at the actual closing price of the asset. The gap simply disappears at the finish line. Now, why is there a gap between these two prices in the first place? It usually comes down to the cost of carry. Think of this as the net cost of holding an asset over time. It includes things like storage costs for physical goods and the interest you pay to borrow money to buy the asset. However, we also subtract any income you earn while holding it, like dividends. Essentially, it is the total cost of carrying that investment forward to a future date. Let us look at a quick example with a company called ABC Limited. If the current share price is 100 and you borrow money at an interest rate of 6% per year, your cost to finance this is 6. But if you expect to receive a dividend of 2 during that year, your net cost of carry is 6 minus 2, which equals 4. Therefore, to break even, your futures price would need to be the spot price of 100 plus the cost of 4, equaling 104. This cost can vary for different investors, but the logic remains the same. Moving on, let us talk about safety and trust. To make sure everyone follows through on their promises, the exchange uses a margin account. You can think of this like a security deposit. When you enter a contract, you must pay an initial margin. For instance, if you buy a Nifty futures contract on May 14, 2024, at 22,250 with a lot size of 25, the total contract value is 556,250. If the broker requires a 10% margin, you would deposit 55,625. Both buyers and sellers pay this to ensure the trade is honored. Since prices change every day, the exchange does not wait until the end of the month to settle gains or losses. Instead, they use a process called marking to market or MTM. Think of this as a daily scorekeeping session. If you bought that Nifty contract at 22,250 and it closes the day at 22,308.70, you have gained 58.70 points. Multiplied by the lot size of 25, your profit for the day is 1,468. This money is added to your account immediately, and your starting point for the next day resets to that new closing price. Next, we have two terms that tell us about the health and size of the market: open interest and volumes traded. Open interest represents the total number of contracts that are currently active and have not been settled yet. It measures the depth of the market. On the other hand, volume tells us about the level of activity or how many contracts changed hands during a specific period, like a single day. While volume counts every single trade that happens, Open interest only counts the contracts that are still standing at the end of the day. To see the difference in action, let us follow a few days in March. On March 1st, when person A sells and person B buys 50 contracts, both the volume and open interest are 50. On March 2nd, two new people trade 100 contracts. So volume for the day is 100 and open interest rises to 150. On March 3rd, person A closes their position, but person E takes it over. Because one person just replaced another and no new net contracts were created, the open interest stays at 150, even though the volume for that day was 50. Finally, on March 4th, when existing traders close their positions, the open interest falls back down to 50. To keep the market stable and prevent chaos, exchanges use a price band. You can think of this as a speed limit for how much a price can move in a single day. Usually, this is calculated based on the previous day's closing price. For example, if a contract closed at 100 and has a 10% limit, it can only trade between 90 and 110 the next day. This prevents wild, uncontrolled price swings and ensures the market stays within a permitted range. When you are active in the market, your status is known as your position. If you have an outstanding buy order that hasn't been settled, you have a long position. For example, if you buy 5 Sensex contracts, you are long. If you have an outstanding sell order, you have a short position. An open position is simply the net amount of any unsettled trades you currently hold, whether they are buy or sell contracts across different companies. Sometimes you might hold a position without owning the underlying asset, which we call a naked position. This is a pure bet on which way the price will move. Alternatively, you might use a calendar spread. This is a strategy where you hold two positions on the same asset but with different end dates. For instance, you could be long on a contract ending this month and short on one ending next month. It is a way to manage risk by focusing on the relationship between two different time periods. Finally, let us clarify how you actually enter and exit these trades. Opening a position means taking a new trade, either buying or selling, which increases your total number of active contracts. Closing a position is the opposite. It means you are getting out of a trade to reduce your open contracts. If you originally bought a contract, you close it by selling it. If you originally sold one, you close it by buying it back. By doing this, you finalize your trade and lock in your results